This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Now, it's very short here. It can only be asked as written. Okay? You can't be asked numbers. It's actually, now I'm jumping a chapter for a deliberate reason. I will be coming back to it. But chapter 19... talks about the effect of changes in gearing. And you'll immediately see, if you've turned to the page, there are some numbers there. As you'll see in a second, the numbers are only there to illustrate what I'm saying. You cannot be asked numbers on this bit in your exam. Okay? And what you've got to be aware of is this. First of all, I hate the name, what we call the traditional theory of gearing. I just mentioned Mr. Modigliani and Mr. Miller. Before they appeared on the scene and did their work, the conventional thinking, which seems very sensible, was this. I will look at example 1 in a minute, but if you turn, page 2.2, there's a graph. Let me explain what it is. The traditional theory was this, that if you drew a graph showing the cost of money as against the level of gearing, hello? The cost of money is against the level of gearing. Up the axis is when there's more gearing. So here, there would be when it was entirely equity financed. As you move along the axis, you're bringing in more and more debt. Clear? Well, for years, people have accepted what I said before and you accepted. That as far as equity is concerned, more gearing makes things more risky. If it's more risky, shareholders want a higher return. And therefore the cost of equity would go up with the level of gearing. Sensible? And that's what you've got there. I wouldn't claim for 1 second it has to be a straight line. It's only illustrative. You know, to illustrate, we always draw a straight line, but it doesn't have to be linear. I don't care. But, you know, maybe if there's no gearing, I'm making up figures, maybe if there's no gearing, shareholders want, let's say, 10%. But, as there's more and more gearing in the company, shareholders want a higher and higher return. Sensible? As far as debt's concerned, well, of course, debt, we've already said, is less risky. In theory, you're getting the fixed interest. So you're not surprised if debt lenders want a lower return. That the cost of debt, again I'm making up a figure, maybe the cost of debt is, let's say, 5%, and in theory it doesn't matter how much debt there is in the company, if there's no risk, you know, it would stay at 5%. You're all with me? We do say in extreme levels, if a company was virtually all debt financed, then think about it. If they were nearly all debt financed, then it starts to be really risky that they can't pay the interest. So, okay, at very high levels, we say perhaps it goes up a bit, you know? And then we say, well, what's going to happen to the weighted average? Well, I think common sense. No theory here, really. We call it theory, but it's not a theory. Surely, if you've no gearing at all you've got is equity, and so the weighted average would, in my example, be 10%. Yep. As you start bringing in cheap debt, would you all agree, cheap debt starts pulling down the average cost? Higher equity is pushing up the average cost. Well, traditional theory said quite simply, as you start changing the proportions, the weighted average stands to change. No? It would seem logical. To illustrate it, we assume it changes in a nice smooth pattern. But again, I don't care. If you think it through, that would make sense. But I don't really care whether it goes down, up, down, up, down, up. And the point is, if you change the proportions, 100% equity, if I change it to 80% equity, 20% debt, 70% equity, 30% debt, if you change the proportions, if the costs are changing, it seems fairly sensible. The weighted average is going to change. All right? And finally, if that were the case, how should a company raise money? Surely what a company should do, if at the moment they were all equity, if bringing in more debt would reduce the weighted average, would it not make sense to bring in more debt? And so what would happen, if a company's up here, they should raise more debt because it's pulling down the overall cost. But if it's going to change, there must be a minimum somewhere. And once they got to the minimum weighted average, surely any more debt would be pushing the cost up, would be more expensive. Any more equity would be pushing it up. Traditional theory says a company should find the minimum weighted average, whatever level of gearing that was, and tell me, once we'd got to that level of gearing, suppose that happened when you were 70% equity, 30% debt. If the company needs more money, how should they raise it? No, hold on. Suppose that level there happened to be, let's say, 70% equity, 30% debt. All right? Peter? And the weighted average was at the minimum level. They need more money. Well, if they raise more equity, surely there's less gearing. You go up here, it gets more expensive. Yeah? So you don't want to raise more equity. On the other hand, if you raise more debt, well, if we're at the minimum, more gearing is going to make it go up, so you don't want to do that. How would the company raise more money once they've got to their best level of gearing? Let's say 70% equity, 30% debt. If they need more money, how should they raise it? Say again? Both. Yeah, the same ratio. Sure, you don't want to change your ratio. If 70-30 was the best, any more money you'd raise in the same ratio. Sensible? And so this was traditional theory. It said there is going to be a minimum which we would call optimal gearing. I say, I'm not claiming for 1 second in real life the graph will be that pretty, but if weighted average is going to change, then by definition, there has to be a minimum, yeah? And so traditionally people said, company should go for the cheapest level of gearing, the optimal gearing, and once they'd got to that level of gearing, they should raise all future money in the same ratio. Sensible? If that's the cheapest, it's pointless having more debt or more equity. You would then keep, or put it another way, you'd raise future money in the same ratio. Now, I do hope I'm making sense, please. There's not much left. But that was the traditional view. Well, now I said you won't get numbers, but since it'll only take you 2 minutes, purely because it's so important you can write properly here, and I think if you can understand these numbers, it makes certain you know what you're talking about. Could you just turn back to example 1? I said it'll only take 2 minutes. You won't get these numbers. Let's see what I'm getting at. I've told you, I've got that table there. Across the top, it's got different levels of gearing. So the first column is when you're 100% equity financed. Second column is if it was 80% equity, 20% debt, and so on. Well, as you can see, and as we'd expect, the cost of equity goes up with higher gearing. I've made up some numbers. Yep. The cost of debt. Well, in a perfect world, the cost of debt would stay constant because there's no risk. But I did say at very high levels of gearing, it starts to become risky. They want more. All right? Well, what's the weighted average cost of capital? I'll start. You finish it. We'll have a race. If it's 100% equity, no debt. What's the weighted average cost of capital, please? Say again, sorry. I think you were right, I didn't quite... Yeah. If you're all equity, surely. Cost of equity is 20%. If it's all equity finance, the weighted average would be 20%. True? If we go to 80% equity, 20% debt, I'm assuming these are market values. Well, the weighted average, would it not be 80% equity at 22, 10% debt at, what was it, 10? Sorry, 20% debt, beg your pardon, at 10%. I think it goes to 19.6%. You all following me here? Peter? Hello? And so, would it be worth, if you needed more money, would it be worth raising a bit of debt? Of course it would, because your overall cost is lower. All right? Right, it only takes a second. Can you finish them off, please? And tell me which would be the best level of gearing. And surely, I mean, do shout if I'm not making any sense. But all these are all invented figures. As you change the ratio, as the costs change, it seems sensible weighted average changes. And if weighted average changes, surely you want to go to the cheapest. The best level of gearing would be 60% equity, 40% debt. And more importantly, how should you raise money in the future? If you keep it to 60-40, you keep the overall cost at 19. Sensible? Well, that was the traditional theory, and for years people accepted that it did matter how you raised money. Okay? But of course the problem is, how do we know what our best gearing is? You know, every company presumably starts off all equity. But it'd be rather nice to know what's my best level of gearing, you know? Well, it didn't really help. I suppose all you could really do was raise a bit of debt, see what happened. Raise a bit more debt. As long as it's going down, you're happy, you know? And then keep checking, and perhaps one day it goes up, and then you think, oh, you know what I'm getting at? Well, this is where Modigliani and Miller appeared in the 1960s. They said, they agreed with all this. They said, as it becomes more risky, shareholders want a higher return, and so on. But they said, in theory, we should be able to calculate what the risk is, what the return is. And in a sense, we should be able to predict. And what they found was really interesting. The first time they did it, if you understand me, their proof, whatever, they looked at the situation when there was no tax. And so the first thing you need is Modigliani and Miller with no taxes. And what they found was astonishing. Now, unfortunately, the proof of what they did isn't in your syllabus. And I'd love to show you, but we'd spend the rest of the day and it would be irrelevant. You'll have to accept this is provable, you know? But again, you've got a graph, so you've no need to draw it yourself. It's on page 105. They did exactly the same thing. The cost, the gearing. And they said, OK, as you increase the gearing in a company, it's more risky for shareholders. The cost of equity will increase. Maybe, as I said before, maybe with no gearing, it's 10%, but as you bring in more and more gearing, it goes up. All right? However, they said it goes up in a very precise way. They came up with a formula for it. And as I say, the formula isn't in your syllabus. It's nearly coffee. So it wasn't just, oh, it might be 12, it might be 15. They said it went up in a very precise way. The cost of debt? Well, they said, right, less risky and so on. The cost of debt will be lower. Maybe it's 5%. In a perfect world, debt is risk-free. It wouldn't matter how much debt there was. Except, again, they did accept that at very high levels, if the company is virtually completely debt-financed, we get risk, they want a higher return. All right? But what was amazing... Sorry, I beg your pardon. This is cost of equity. This is cost of debt. But what was amazing is when they put the two together and got the weighted average. Again, if you're all equity, the cost of equity on my figures would be 10%. As you bring in more debt, the cheap debt is pulling down the cost, but the higher equity is pulling up the cost. You agree? They proved that the net effect cancelled out. They proved that the weighted average cost of capital would, in fact, stay constant. The debt makes it cheaper, the equity makes it more expensive, but the net effect, that the weighted average would stay the same, whatever the level of gearing. All right? Now, as I say, proving that isn't in your syllabus. And it was actually very funny. It was in the Harvard Business Review or something. Modigliani and Miller came up with this, and a proof. In the next edition, I think it comes out every 3 months, in the next edition, two people called Mr. Heinz and Mr. Heinz and Sprenkel, they wrote an article saying what Modigliani and Miller did was interesting, but the proof was wrong. They proved it a different way, but came up with the same conclusion. And in the next edition of the Harvard Business Review, Modigliani and Miller wrote another article thanking Heinz and Sprenkel for their work, but saying their proof was wrong, and coming up with a third proof, which still came to the same thing. So it was proved three different... That's when you look at them, 3 different ways are all actually the same, almost. But anyway, it was proved 3 different ways. But it's certainly in a perfect world, with no taxes, the weighted average cost of capital, they decided would stay constant. And more importantly, if that's true, how should a company raise money? If that is true, if I need more money, should I raise debt or should I raise equity?
Debt.
Why? Hold on, the overall cost will be unchanged. Debt may be cheaper, but equity becomes more expensive. You with me? According to Modigliani and Miller, if that's true, it is irrelevant how you raise money. It doesn't matter whether you raise debt or equity. The overall cost will stay exactly the same. Debt may look cheap, but equity is more expensive. The net effect. Do you understand me? They said it was completely irrelevant how you raised money. Does that make sense, everybody? Please. If what they say is true. Doesn't make any odds how you raise money. The end result is the same. If it's 10% now, it's always 10%, you know. There's no such thing as cheap debt or whatever. Now, a lot of people cannot see how that could work. Well, again, be patient with me for 2 minutes. Although you won't be able to ask numbers, just look at example 2. Same idea. If it's all equity, the cost of equity is 20%. As you bring in more debt, cost of equity goes up. Yep. But according to Modigliani and Miller, it would go up in a very precise way. All right? Just look what happens to the weighted average. If it's all equity, if it's 100% equity, what's the weighted average cost? If it's all equity, it's 20%. Do you agree, Vita? Hello? If it goes 80% equity, 20% debt. Debt is a lot cheaper. Debt is 10%. But equity's gone up to 22.5. What happens to the weighted average? Yeah, I won't waste your time, but check it. The weighted average stays at 20%. All I'm trying to do is prove to you on numbers it can happen, you know? And I mean, I shouldn't need to, but I mean 50-50 is pretty obvious. Debt equity's gone up even more, 30%. Debt's 10, it's cheap. But the weighted average, cheap debt, higher equity, 50% of each. The weighted average stays at 20. I'm not going to do the fourth, I'm sure you can accept. Yeah? But, as I say, no such thing as cheap debt or anything. The weighted average will stay the same. Well, I'm not going to repeat why. Okay? All right, we're virtually there. There's one more. I know break's late. Are you all right just for 2 or 3 minutes, everybody? Nobody's about to burst. All right, well, the downside there, of course, although it was, you cannot imagine the effect this had, what they said. As I said, they got the Nobel Prize for it. It was astonishing. It was the whole start of financial management theory. The downside, of course, is it's not practical. It assumed no taxes. And in real life, clearly, there is. And so they then went on and looked at the situation where there is tax. Modigliani and Miller, with corporation tax, company tax, although, for your exam, the one you need, ignoring income tax. In fact, they did carry on later and bring in income tax, but that isn't in your syllabus. But they brought in company tax. And in fact, if you accept what I just said, if you accept that what I just said is provable, then it's very obvious what the effect of corporation tax is going to be. We'll do the graph. But higher gearing, cost of equity, with more gearing, will go up. Yep. Again, in a very precise way. And remember, tax or no tax, cost of equity isn't affected. Dividends aren't tax allowable. All right? So if without tax, investors wanted 10% going up, the company pays 10% going up. Bring in tax. Investors still want 10% going up, and the company still pays 10% going up. You understand me? But what would be affected, surely, is the cost of debt. Because if there's no tax, investors want 5%, company pays 5%. Bring in tax, presumably the investor still wants 5, but because of tax relief, the cost to the company is lower. True? And so you end up with exactly the same picture the cost of equity, if it's 10%, let's say, with no gearing, higher gearing, it goes up. And again, they had a formula, it went up in a very precise way. All right? Cost of debt. Well, before investors, I said, wanted 5, company paid 5. I'm saying now, right, investors will still want 5, but company pays less because of tax relief. The cost of debt would be lower. You're understanding me? You know, on silly figures, it was 5 before. Bringing tax relief, maybe it's only 3. Well, you can tell me what's going to happen. When cost of debt was 5 and there's no tax, higher equity, lower debt, they cancelled out. Weighted average stayed constant. The only thing that's changed is debt's become a lot cheaper. If debt becomes a lot cheaper, what's going to happen? Think about it. Surely the weighted average cost of capital will fall. If there was no tax, cheap debt is cancelled by higher equity. Tax made the debt cheaper still. If it makes it cheaper still, more debt will mean lower weighted average cost. And the final conclusion, there were 2 lines. The weighted average cost of capital will fall with higher gearing. But for one and only one reason, the only reason it falls with higher gearing is because of the tax relief on debt. There is no other reason, according to Modigliani and Miller. No other reason. If it wasn't for tax relief, it would be irrelevant. Because the current tax system, debt gets tax saving, dividends don't. Yeah, that and that alone makes debt attractive. All right? The second, the final conclusion you'll be able to write is, I hope, very obvious. If a company wants to raise more money, and if this is true, how should my company raise more money? More debt, surely. You want to borrow as cheap as you possibly can. If the weighted average wasn't going to change, we said before, irrelevant. Yeah? But if more debt means lower overall cost, then finally, company should raise as much debt as possible. All right, there'll be practical limits. You can't be 100% debt financed. There'll come a time when people won't lend you anymore, sort of thing. But subject to that, Modigliani and Miller said a company should raise as much debt as possible. But only because of the tax relief. There is no other reason for doing it. Okay? All right, well, as I say, as far as theories of gearing are concerned, no numbers until you get to P4. But he does expect you to be able to write down briefly. Traditional theory says weighted average will change. Find a minimum, and that's the best level, you know. Modigliani and Miller say that without tax, weighted average doesn't change. And I hope you all do see the implication. if the overall cost was going to stay the same whatever happened, there's no such thing as a cheapest way of raising money. You agree? But finally, bring in corporation tax. The weighted average will fall with higher gearing. But, can I stress again, the only reason it falls is because of the tax relief. If the tax system changed and you didn't get tax relief, the benefit would be removed. But under the current system, if you like, weighted average will fall because of tax relief, and therefore, I hope it makes sense, it does make debt cheaper. They should raise as much debt as they possibly can. All right? Now, as I say, that's as far as it goes in the exam, almost anyway. They did, in fact, do a third proof, because, of course, we're ignoring income tax. Yeah? And in fact, although you're not interested, or maybe you are interested, but you're certainly not interested for the exam. In the exam, we always ignore income tax. Out of interest, income tax does in fact take away a bit of the benefit, but debt is still attractive. It's not quite as attractive, but debt still is attractive. The same conclusion remains. All right? But anyway, I'm not concerned. The only other thing he can ask, though, is, as you'd expect, Modigliani and Miller, when they proved everything, even though the proof isn't in the syllabus, they did assume, in a sense, it was a perfect world. They made lots of assumptions. And although people do accept that essentially what Modigliani and Miller says is true, in the real world it doesn't work perfectly because they made all these assumptions. All right? And the examiner doesn't expect you to be aware of their main assumptions, and I've listed them on page 108. Now, you won't expect any detail here. Most of them, I think, are reasonably obvious. One of them is a bit annoying because without the proof, one of them isn't particularly obvious. But the main assumptions are there. One is that shareholders have perfect knowledge. All I mean there is, you see, we say market value... Sorry. Inherent in the proof is this idea we've said all along, that market value is present value of future expected receipts, you know, future expected dividends. Well, we do assume that shareholders have perfect knowledge of what's happening in the company, which isn't the case, obviously. Companies make decisions and things, and shareholders don't always know. You with me? It does assume that shareholders know everything, and therefore they base it on their expectations on the truth, not on rumours. Yep. I might as well do the same order. They act rationally with regard to risk. I said, and it seems sensible, that if things are more risky, shareholders will want a higher return. That seems sensible. But not all shareholders are sensible. Well, they assume shareholders are sensible and will want a higher return, you know? You with me? The third one, a perfect market. All I mean by that is, again, we say all along the share price is determined by the dividends they expect and the required return. And so, and I said before, it is true in real life. If a company pays higher dividends, announces higher dividends, in real life the share price does go up. Yeah? But in real life it often takes time, because share prices only move when people are buying and selling. So if today it happened that nobody had any money, I'm being extreme here, but if nobody had any money today, so nobody's buying shares, the share price doesn't change. So the company may announce higher dividends, but it may be a few days later before the share price goes up. Yeah? Well, perfect market, we assume the share price instantly reacts, you know? The fourth one is, I hope, obvious from everything I've said. They do assume, of course, that interest is tax allowable and that you are able to get the tax relief. I said earlier, of course, you only get the benefit of tax relief if you are paying tax. If the company's making tax losses and not paying tax, you're not saving tax. Yeah? So it does assume we get tax relief and that we are able to get the benefit. The last one, if I just jump one and come back to the other one, the debt borrowing is irredeemable. Their proof assumes irredeemable debt, never repayable. And I said earlier, in real life, that doesn't exist. People won't lend money unless they're going to get repaid. All right? In a sense, you could get round it by assuming that when it came time to repay, you repaid it by issuing more debt. And so effectively, you carry on paying interest forever, you know? But even then, it wouldn't quite work. But strictly, I mean, the proof strictly only works if it's irredeemable. Okay? The last one, I'll try and explain, but it's slightly annoying that he could expect you to mention it, because it only makes real sense if you'd seen the proof. And I say to go through the whole proof would be wasting your time, because it isn't required and it would take a while. But all I mean by that, you see, is I said what makes shares more risky is the interest payable. You see, if you have a company which has got operating profits, profits before interest of 100, if they have to pay fixed interest of, let's say, 20 a year, the amount available for dividend is 80. You don't need to take this down, but that does make sense, does it? Hello? And I said last time, I'm not going to repeat, that the reason the dividend's risky is because that fixed interest is always payable. The profits may go up and down, but because you're always paying the fixed interest, it makes the dividend itself more risky. All right? Well, the way they prove it is they imagine two companies. They say, oh, you could invest here and you'll get a dividend, but it's risky, okay, because of that interest. And they compare it with investing in another company. Maybe another company doesn't have any interest at all. All right? And they start comparing the two. But of course, you can't compare the two if one is more risky than another. Am I making sense here? So they say, how can we make them comparable? Forget the actual numbers. You know, maybe the other one gave 90 or something. But how can you say which is better of the two? Oh, sorry, let me make the point. Suppose another one gave 70. If I said to you which is better, how can you compare 70 when there's no risk and 80 when there is risk? You see what I'm getting at? And so what they did, in order that we could compare, they said, oh, that one's risky because the company's paying fixed interest. In order to compare, well, we'd have to have the same riskiness in the other one, yeah? So what they did was said, let's imagine that the investor in the other one borrowed money himself and that he had to pay fixed interest. Because if he borrows money himself and has to pay 20 a year fixed interest, then they say, oh, now we can compare the two, because in both cases, your dividend is after fixed interest. I think you probably see what I'm getting at. And they say, now we can compare, and if it's got the same riskiness because of the fixed interest, then whichever gives them more money is the better. Yeah? That's the sort of way they go about proving it. Well, that's what this means. They have assumed that investors are indifferent between corporate gearing, where the company's paying fixed interest, and personal gearing, where you yourself are paying fixed interest. All right? And of course, there's one big problem there. If the company goes bankrupt, if this company goes bankrupt, the investor isn't responsible for the interest payments. You agree? If this company goes bankrupt and you've borrowed personally, you still have to pay the interest payments. It's not the same. The net effect, and you can add one more in. Because of that, the other reservation is Modigliani and Miller. They ignore what we call the fear of bankruptcy. They ignore the fear in bankruptcy. Because again, if the company goes bankrupt, it's completely different as to who's responsible for the interest. All right? And they ignore it all the way through. And in fact, of course, Modigliani and Miller have come into a bit of, I was going to say complaints. I mean, there's been a bit of a problem recently. Because of Modigliani and Miller, companies have been borrowing lots of debt, you know, cheap. But of course you hit the crisis. And of course the more interest the company's paying, the more risk there is of the company going bankrupt. And of course that's what's happened to a lot of companies more recently. They've overborrowed, profits fall, they can't pay the interest. Okay? So maybe Modigliani and Miller had a nice idea, but it's not always sensible. It's sensible when things are doing well, but there is that risk. You see my point? When things do badly. Okay? However, there we are. And in fact, if you look back for a second at that question I gave you earlier, where we worked out cost of capital, if you look back at it, we did part A before break, calculate the current weighted average cost of capital. I think that was a reasonably easy 9 marks. Okay, in the middle of an exam, obviously, more chance of silly mistakes and so on, but I think essentially pretty straightforward. Last time we'd done part C, and you may have forgotten, but although part C was quite a bit of messing around, it was completely separate. And again, I don't think it was too bad to get certainly most of the marks. But look at part B for 8 marks. Discuss whether financial management theory suggests that Droxfall can reduce its weighted average cost to a minimum level. Now, it may not be immediately obvious, but that's the way he asks what I've just said. I'll give you his answer. You can read it at home. But his answer says exactly what I said. Traditional theory says yes, weighted average will change and there will be a minimum. Modigliani and Miller theory says without tax, weighted average won't change and there is no such thing as a minimum. But finally, Modigliani and Miller with tax says that, all right, there will be a minimum, but it's raising as much debt as possible. Okay? He expected all 3. 8 marks. And although, again, it took me a while to say because I was trying to explain, there's not actually a lot to write, just those 3 ideas. Okay? You won't need numbers. Those graphs I drew, you don't need the graphs. I don't know, if there's enough marks, if it helps explain, often a graph is easier than a lot of words, you know. If you want to help explain, fine. But you're never required to draw them. But that's the way it is. And if you've understood me, Again, well, it's just so standard. I don't think that's too bad for 8 marks. Okay? I'll give you his. Don't read it now, read it tonight. But as always, he writes more than he expects. But he's certainly written no more than I've said, you know. But he did want all 3. Okay? Fine. Actually, it's very sad. I mean, particularly Miller was so famous because they were the first people to come up with any theory of financial management. There's another theory coming, capital asset pricing model we'll come to later. But they started it all going, if you're with me. As I said, they got the Nobel Prize. And they became really famous for it. And Mr. Miller, who died about 3 or 4 years ago, it was really sad. He was a very clever man. And he set up a unit trust. A unit trust? A mutual fund, you know, where people put money in and he was investing it for them. And because he was so famous and people thought he was the world expert, you know, on managing finance, loads of people put money in. And he was very honest, he didn't do anything wrong, but the whole thing collapsed. People lost loads of money. Not because he was cheating, because, you know, theory doesn't always work. And it was really sad. I mean,